Welcome to RBC's Markets in Motion podcast, recorded June 29th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. With the first half of 2026 coming to a close, today we're refreshing our thoughts on the year ahead outlook for U.S. equities. The big things you need to know? First, we've lifted our 12-month S&P 500 price target to 8150 from 7900. We also think the recent outperformance of non-U.S. developed markets in value could last a bit longer, but ultimately expect equity market leadership to return to the U.S. and big cap growth after the recent valuation problem is resolved. Second, we run through our thoughts on the upcoming reporting season, noting that the bar seems high from a data perspective. Third, the latest Duke CFO survey pointed to a slight downtick on economic optimism, but a slight uptick on optimism on the outlook for one's own company. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1, lifting our 12-month S&P 500 price target to 8150 and thoughts on recent leadership rotations. When we froze our models last Thursday, the S&P 500's price level was similar to that in place at the time of our last update in May, and most of our models were sending the same signal or a similar one to what we're seeing today. There are 2 changes in our thinking and modeling to be aware of. The first is methodology. We're once again linking our target to an approximation of the median and average of 5 models on sentiment, valuation and earnings, stock versus bonds, and GDP backdrop, and the monetary policy environment. In our last update in May, we linked our target to an approximation of our valuation and earnings model, which gave us the best ability to fine-tune our assumptions on AI earnings strength and the impacts from the situation in the Middle East. But this seems like a slightly less pressing need, given additional de-escalation in the conflict. This is important because the story we're seeing in the numbers broadly is that the stock market deserves to move higher over the next year from a variety of perspectives. Subdued sentiment that still has room to climb a wall of worry, earnings tailwinds that offset PE headwinds in the form of possible interest rate and inflation pressures, a solid GDP backdrop, and a monetary policy backdrop that's still conducive to further gains. The second change to be aware of is that our valuation and earnings model actually now points to a higher fair value for the index. That model is now calling for 8162, up from 7929 previously. This is largely because our June update bakes in a higher earnings assumption. The bottom-up consensus for 1Q27, which remains the reference point for this model for now, has moved up since our May update. Note we're still haircutting that consensus by 5%. Our June update now also employs a slightly more favorable PE assumption due to a slightly lower inflation assumption of 3%, down from 3.3 previously, which offsets the addition of a single hike into our model. All of that being said, we continue to believe that the path for stocks in the year ahead will not necessarily be a linear one. Tactical risks we're monitoring include further profit-taking on semis and other AI winners, war setbacks, the potential need for downward adjustments to bottom-up consensus 2027 S&P 500 EPS forecasts, the U.S. midterm elections coming up later this year, and rising interest rates and Fed hikes. We expect pullbacks to be no worse than 5 to 10% from peak, Tier 1 on our 4 tiers of fear framework, as long as the risk of a recession and/or a major interest rate shock stays low. We've also refreshed our views on the key higher-level positioning trades that we track closely. U.S. versus non-U.S. developed markets, U.S. growth versus value, and small cap. In the case of U.S. non-U.S. and growth value, we think leadership by non-U.S. and value has room to run, but still think of these as trades rather than longer-term shifts in leadership. While we look at other factors as well, our valuation work has helped to inform our view on both of these calls. Before the latest rotations back to non-U.S. and value began, our valuation work had been signaling that the U.S. was no longer cheap versus non-U.S. on next 12 months PE, a condition that had helped usher in U.S. leadership in March. And we also saw that the median next 12 months PE of the top 10 market cap names in the S&P 500 had moved up above 30 times, getting close to the ceilings of the past few years. What we're seeing today suggests that the valuation correction in the U.S. generally and U.S. megacap growth in particular may not have fully played out. The U.S. is below the 5-year average relative to non-U.S., but not back to prior lows. Meanwhile, the S&P 500 top 10 market cap names are also down, but also haven't hit prior lows. Moving on to takeaway number 2, a high bar on the stats heading into 2Q26 reporting season. Bottom-up consensus expects 23% growth for S&P EPS in 2Q26, year-over-year on the quarterly data point, a slower pace than the 30% growth seen for 1Q26. But bottom-up consensus 2Q S&P EPS estimates in terms of the embedded growth rates have been moving up, which has also been the case for 3Q26, 4Q26, 1Q27, and 2Q27. Meanwhile, all the sectors in the S&P 500 have experienced a positive rate of upward revisions on both earnings and revenues in recent weeks, aside from comm services. Within the S&P 500, the biggest market cap names, which have been doing all the heavy lifting on earnings, have already hit peak levels of upward revisions and have slipped a bit from those levels. Earnings will be quiet around the upcoming July 4th holiday in the U.S. and will start to pick up the week of July 13th. The recent wobble in the equity market may admittedly reflect the idea that earnings sentiment needs to cool off a bit. And we'll wrap up very quickly with takeaway number 3, clues on the C-suite tone. We always look forward to the release of the Duke CFO survey shortly before reporting season, as it gives us a baseline for the C-suite tone once results start to come in. The results of the latest survey, taken May 18th to June 5th and released last week, highlighted a slight downtick on the economic outlook, but a slight uptick on optimism on one's own company. The gap between the two does remain wide, as has been the case since COVID. This is something we think speaks to the resiliency of corporate America and confidence in their ability to manage through. Inflation and non-labor costs were the top concerns, replacing tariffs and trade from the last survey. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.